Now we can continue our session on deal architects. Today I'm here with the builders, not house, bridges or constructions, but the market itself. So we have a very interesting session in this panel. So we will talk about the architects. When we say architects, it's about our intermediaries and their roles in our markets. And as you know from the theme of the event, this event is not about launching the market. Now we are laying foundation and growth. So the foundation be based on quality, integrity, market trust, and investor protections. So our architects will explore us on the challenge of deal making in Ethiopia. What are the ethical standards? And from the global perspective, David will give us a highlight on the lessons we learn and experience from the global perspectives. So I will take a few moments to introduce our STEM panelists. I will start in order of their licensing time. So I will start with Teddy. Tedros, he is from Deloitte, one of the first licensed service providers in Ethiopia. And then we have Dr. Gamachu. He is CEO of iCapital, the first locally owned corporate investment advisor in Ethiopia. And then we have Michael with us, CEO of First Addis Investment Bank, the first non-banking group investment bank in Ethiopia. And also we have David from Ghana Bargain Investment Holding and Advisors. He is also a CEO. So I'm joined by 4 CEOs, 3 firsts in Ethiopian market, and also the global perspectives. So I will just dive in the question. David, I will start with you, and to set the stage and to connect with our audience while we say deal structure. So take us through what we mean by deal structuring and why we say investment banks, advisors and brokers, the deal architects, because people might think that from licensing department, so I'm calling you architects. So take us through those concepts to set the stage, and we'll continue with Dr. Gamacho and Mike.
Okay, thank you, Idris, and good afternoon to everyone, especially those who managed to stay on after the last coffee break. I know it's been a long day, but happy to be here. When we talk about deal structuring, it is simply how you convert, a financing idea into a market-ready financial instrument. So you would look at the difference between a transaction that will die in the boardroom versus a transaction that will actually end up successful in the market. And everything that is in between is what we call deal structuring. So it will involve something like designing an instrument. So first of all, selecting, are we doing an equity issue? Are we doing a bond? Is this some SPV? So deciding on what instrument would best represent that idea or that financing need. Would look at the risk and return. What are the risks associated with that instrument that we are selecting? What kind of return will we be able to deliver to the investors that we are targeting? We'd have to look at the legal and regulatory fit. So what are the laws that pertain to a particular kind of issuance? In Ethiopia, we'd be looking at, the ECMA rules. If we are going to the market, we'll be looking at ESX rules. We'll be looking at any other, if it's a bank, you need to be sure that you're also compliant with the banking sector rules. So you look at the rule fit, and we have to look at pricing. What is the pricing? If it's debt, if it's equity, how are we going to price it? And the timing of that. So that also goes into what will determine the structure. We have to look at what investors are going to put money into this. So we need to understand the psyche of every investor. Are we targeting retail? Are we looking at insurance? If it's insurance, or are we looking at pensions? And how is it going to fit? So we need to understand what kind of return or what kind of profile that these investors have. And how are we going to distribute it? Is it just local or is it just global? Right, that we also need to determine how we're going to distribute to raise that money. So that goes into the structure. And why do we call advisors architects? We call them architects because they are the ones that are going to put all these things together and ensure that it actually works. So an advisor is somebody who will convert this financing idea into something that is bankable, that people can actually put their money in. So they are the ones who will coordinate all the group of specialists. If there's a transaction or there's a deal, there will be lawyers involved, there could be auditors. If it's a debt instrument, there could be credit rating agencies, there could be regulators, there are trustees, there are custodians. So the advisor or the broker or the investment bank is the person in the middle who's going to put all the people involved in this together. So they will go and negotiate with the regulator, they will prepare the documentation, they will lead execution, they will lead engagements with investors, they will lead roadshows, then they will lead the closure where you actually draw down on capital and ensure that there's closure, and the deal is consummated and the financing idea has actually closed, or whatever issuer is looking for money actually receives the money, and there are investors that have put money behind that transaction. So in effect, how a market would actually evolve or how well a market would do is determined by the nature of the architects, right? The advisors in that market. So to sum it, how well Ethiopia would do, how we will progress from here, depends on the sophistication and the innovation that will come from the architects that are playing in that market.
Thank you, David, for this brief highlight on what deal structure is within the capital market context. So I will go to the next question to Dr. Gamachu, followed by Mikhail. So David highlighted what the deal structure, the ideals of the deal structure. And I want you to address and to touch on the points. What are the biggest challenges currently in our market in Ethiopia that are challenging not to have a quality deal and to proceed to deepen our market, to make our market vibrant and liquid? So what are, in your opinion, the biggest challenge for the quality flow of deal in Ethiopia, in your opinion? Dr. Gamachu can proceed and Michael will go next.
Thank you very much, Idris. And good afternoon, good evening, everyone. And I would like to say congratulations to the ECMA team for putting this consistently last year and this year, and it will continue as well. So 1 year experience. Before we started, we got the license, of course, like you mentioned earlier. We have done our own preparation, and the things that we have known as concepts and exposures from other countries, now we started to leave them and see them through happening. And those are the challenges that I would definitely mention, but still yet we are at an early stage experiencing the whole process. So at least we can, what I'm going to mention is based on our experience so far and what we observed. And so generally putting it together, I could say, there is capital market standards that's expected. At the same time, there is a, readiness from the issuers. So this is the major, putting it all, summing all together and bridging this could be the major challenge. And I would say companies, I don't think we have lack of companies, number of companies who are potential in this market. We have a number of them. I think if you only take share companies, they are quite a large number, and potentially who could possibly go to IPOs, there are also more larger. But the transaction-ready companies are lacking. So as you have seen it, many of them, even for the last 1 year, for the registration, the registration that's requirement, many of them have come at the last minute. And that is one of the challenges, because a year was given, but everyone tends to come at the last minute. Solomon was mentioning in the earlier discussion, how the last minute rush, and as the transaction advisors, or I like the term, the phrase architects, right? That sounds very good. So unpacking this and others, I could say issuer preparation is one of the challenges. Readiness is one of the challenges. In a way, all the documents that is required for the structuring of the deal. Mainly previously they were meant for tax purposes or they were meant for legal requirements, not for investors' consumption. So all this is one of the things. So looking at the documents, looking at what they have already put in place, probably the governance, clean financials, including the mindset related to risk disclosure, all those sorts of things are one of, the challenge that I would put under, the issuers preparedness related one. So housekeeping is one of the things, like before you go, housekeeping takes a lot of time. And the other one is even those that have this information and data, because we don't have any data of our own, as deal structuring the pipeline and the deals. We don't have our own data. We rely heavily on the issuers' data and the way they are put together. And some of them are fragmented and some of them are missing, especially if you look at outside of the finance sector, which their primary regulators is not as strict, as expected. That's another issue. So for us, as deal architects, even though we want to structure something meaningful from investor perspective, I think if there is no quality information, that would be, challenging. So the other one is that's why we believe the PO directive itself and all other related to that requires as many disclosure, as many information to come out. In a way, that's another thing. And the other thing is, I think not admitting the shift in culture. This is not about only structuring deals or something. It's fundamentally from issuers' perspective. It's a mindset shift. It requires ecosystem perspective, and those are the challenges that I see. So the transition from collateral-based banking to exposure-based capital market system, not understanding that coming through is another challenge, what we see from issuer perspective. And as deal architects ourselves, again, because this is a new experience for us, so we have this thing that we call for ourselves at iCapital, we say, okay, go as you learn. I'm learning on the go. Because a year ago, our understanding of the practical challenge is completely different from what we know today. But we had to train ourselves. We have to learn. We have to get exposed. The way we deal with the issuers and all observing the regulatory requirements, that's one aspect to that. And also our role, and the way we look at our role as well. We are not only designers or architects like you mentioned, but also we are ecosystem builders. So every action that we take, the way things we do, they are consequential. Understanding this and taking the responsibility could also be a challenge. The other side is the investor side. Also investor readiness, all other aspects. And generally what I would say is the problem is not finding companies, but preparing them and investable and bankable, making them ready for that, along with other challenges. These are some of the challenges that I see. But in general, there is a lot of opportunities and hopes that we see, and learning is taking place, and shifts we have witnessed before our eyes, change in mindset, in terms of understanding is happening. But these are a few of the challenges that I wanted to highlight. Thank you.
Thank you, Doctor. And maybe Mikhail can follow up on that question as well.
Thank you. And also I would like to congratulate ECMA, for putting this together and then, creating this platform for especially the relatively newcomers on this capital market platform. And yes, most of the points have been touched upon by Dr. Gamechu, but deal is the bottom line for any capital market. Every preparation that we do, all the licensing, the service providers, sourcing, etc. But at the end of the day, we have to close some sort of deal between the demand and supply side of the capital market. So for me, the challenge, as someone who has worked on the private sector, financial sector for more than 2 decades, I think the starting point will be not even trying to fit in the standard capital market services and products into the Ethiopian context, because every country is unique, and as we all understand, almost all of the private companies, be it the share companies or the PLCs, are less than 25, 30 years old in Ethiopia. And still majority of them are family owned. And the share companies, I don't know if we know the exact number, but from our short experience in dealing with the share registration and also working with them in various projects, there is a very unique dynamics, even in the share companies. You know, the boards, in how many of them are real board members versus, nominal board members, or who have like a majority stake, and do they understand any of the capital market products? So I think for me, the main challenge in sourcing and originating and structuring and finally closing a deal starts with understanding to the bottom of the political economy and then the dynamics and nature of the private sector, be it the PLCs or the share companies, mapping them out, and then who are they, why are they where they are, because some of them are like 25, 30 years old, but they still have a total capital of 20 million birr after 20, 25 years. So what kind of deal would fit to this kind of companies? Second one, which will be the main responsibility for the deal architects or the transaction advisors and investment banks, would be coming up with a value proposition. Now, are we going to impose, or do we just do the usual marketing that's done in a developed and mature market, or do we structure and package our services and products within the legal framework and under our license to the need and the demand of the issuers as well as the investors? So instead of coming up with a standard pitch documents and presentations, I think we have to customize it to the real context of the Ethiopian, financial sector, banking sector, insurance, and also overall the forex regime. All these have to be put in place in designing the right product. So the second area would be being unable to come up with a solution, product and service package, or in general a value proposition that falls within the legal framework, but at the same time also meets the need of both the investors and the issuers. So that will be an assignment on us to have in-depth understanding, and then being creative and demand-driven to structure our deals and then offer it that way. And the third part will be, reaching out and communication. As it was already mentioned, most of the players, including on the advisory service providers and also the demand side on the market, are new to what a capital market can do and then what solutions it can offer. So what kind of potential customer outreach do we do? Do we do a one-to-one presentation and pitching, understanding their demand, or should we just, have a standard communication and marketing mechanism? Because that way, I don't think the demand is going to come to us. I think we have to go there. Otherwise, there will be majority of the business will be wait and see mode, because you never know what kind of risk you're going to take, especially when it comes to disclosure, opening up your book, and your governance structure. So, and you're also mostly in your comfort zone. So we have to bring the business out of their comfort zone by coming up with a more appealing and attractive value proposition. Last but not least would be the external factor. That is, the macro. Because the capital, we don't necessarily have to rely on only domestic capital. We expect it to come from abroad. So, stability on the forex regime, regulatory framework will be very important, but also sophistication of our banking industry, because capital market will heavily rely on the commercial banking industry, because whether you have an LBO or other kinds of instruments, Still, if it's a collateral-based, engineering-based valuation of any project and idea, I don't think capital market will be able to leverage on the existing resource. So I think sophistication in our banking industry has a long way to go in order to make deal origination in the Ethiopian capital market a reality at a scale that can sustain the service providers in the market itself. And that should be it or not. Thank you.
Thank you, Mikhail. So both Dr. Gamachu, Mikhail, and David also touch on the issue of valuation, value proposition, pricing, and so on. So I will emphasize on the pricing side. So my next question will be for Teddy. So in your opinion, with a limited transaction history in our market, how fair pricing and valuation should be done in your opinion, and how valuation discipline can be ensured in this emerging market?
Thank you very much. Good afternoon, everyone. And thank you for staying this long, and thank you for ECMA for inviting us to be here. I remember last year, I was also on the last panel, and a lot of people stayed behind. It's actually really amazing to see the turn up, so thank you for that. The issue of valuation, I'll try not to be technical and boring, but it's a very sensitive topic. It's a very important topic when it comes to capital markets and capital market related activities. Valuation in any jurisdiction is a very, again, sensitive topic which has to be dealt with very carefully. It's more so in a market like Ethiopia, where information quality is minimal, as well as availability of information is limited. It becomes an exercise that requires a lot of judgment from intermediaries, which is the advisors. Now, one of the thing I've done valuation in Ethiopia for the past 16 years, across the Africa continent as well. But in Ethiopia particularly, one of the things that I always face, especially in board meetings, is the issue of, or the distinction between price and value. When we try to understand a fair value, basically fair value is a price an asset fetches in a market, in an arm's length transaction between knowledgeable and willing buyers. Now, what you hear in the news is price, not value. So when you are in a board meeting, always the question is the difference between price and value, and then explaining that, which is very critical. Someone once said price and value are cousins but not twins, which basically means price is a fact. It's already known. It's a price paid for an asset, while a value is what the business worth. It's an estimate. It's not a fact. So where do they intersect? Where do they become cousins? So when you take value and go into negotiation, bargaining, and then all the noise clears out, and the two parties agree to pay a price, then value turns into a price. So it's an understanding of this is very critical. And in jurisdictions like Ethiopia, that valuation discipline becomes very critical. This is one of the main reasons from ECMA's focus in Ethiopia perspective is there is high focus in terms of how value is determined or how price is determined. So when we look at that, process really matters. One of the key disciplines within valuation is following a predetermined process in which you rely more from a cash flow point of view, scrutinizing it and making sure that the cash flow makes sense, the asset base makes sense, there is a scalability in the business. So when you stand to defend the assumptions, those assumptions are defendable. It's very important and very critical. So this is around the discounted cash flow methodology that we usually use. But if you use a discounted valuation alone, and valuation, so you'll be biased. Because you're getting this information, most of the information from management is biased. Business is like your child. You raised the business to reach a certain level, and then you are always biased in terms of the future outlook of your business, the future cash flow of your business. This is why the judgment from the advisor side becomes very critical. You need to apply different methodologies as well. You need to look at transaction multiples. What happened in the market? This is the price. Someone paid for the similar assets in other places. You need to look at trading multiples. These are companies, listed companies with similar structure with the asset that you are looking at. So it becomes very critical to look into these three methodologies and you triangulate it so that you don't be biased by one specific methodology. Now, the other tricky part is now going into adjustment because valuation needs to be adjusted, right? Ethiopia and South Africa are not the same. Ethiopia and Nigeria are not the same. Our regulatory market political structure is different. Our macroeconomic structure is different. So you need to adjust for those. You need to look into whether your client is offering a control or they are selling minority. If it's a minority, there will be a liquidity challenge. So all these things need to be adjusted into the valuation. Now, the last things I want to say is, this is what I always say whenever I train my team, is when you do a valuation exercise, the key things always to remember is do not fall in love with your deals. It's very easy to fall in love with that specific deal, so you become very much biased, and then your valuation assumptions, everything will be biased in that process. You need to have, at least advisors need to have an internal process, risk process, where that valuation report goes through a certain level of reviews. It's a critical part of the valuation discipline that need to be in place. And don't shift methodologies to fit a certain narrative, to fit a certain client expectation. You have to stand your ground if it doesn't make for a client, and you have to explain it to a client, because a client always wants a higher price. If they are selling, they want a higher price. If they are buying, they want a less price or lower price. So you have to always balance those requirements. So the three things is consistent methodology, consistent processes, and reasonable assumptions. So these are the key valuation disciplines, and it's very critical for the Ethiopia market as we speak.
Thank you, Tedros. And my next question will be for Mikhail. As our previous panelists described from Simon and from the Nigerian from the Nigerian regulators, one of the key issues that was discussed was about disclosure. So it is also one of the key components of the structuring the deal and deal structuring. So how we can push disclosure beyond compliance? How can we protect the investors? Because in emerging market, even with full disclosures, investors might not have a financial literacy to get to the details of the prospectus, to get the details of the deals, and invest with a financial know-how. So how can we push the disclosures beyond those compliance of regulatory compliance and protect the investors, in your opinion?
Sure. Okay. Thank you, Idris. So, if adequate, consistent, accurate disclosure, it's a foundation for any properly functioning capital market. And, because disclosure could mean many things, but at the end of the day, that's about information. And investment is primarily factor of two things, risk and return. So the information or the disclosure that we provide should be able to provide, enough, adequate, reliable, timely, and also consistent information to the decision makers, which will affect and also in a way reduce, if it cannot fully avoid, both positive and negative bias. Especially in a market like Ethiopia, where we say the level of awareness is relatively low, both from the issuer and also from the investor's point of view, then educating and increasing the level of awareness on the need and necessity of adequate disclosure is very critical. If I give some examples, what needs to be disclosed? The traditional securities dealing about primarily, financial institutions, It's just based on network and convenience and some positive news on the newspaper that, okay, this bank this year has made the highest or has paid the highest dividend. Even the focus is not about the underlying drivers. It's mostly about the dividend per share. And then next year, the share value, although we don't have an established market or we don't have one, it's highly dependent on how much dividend did they pay last year, and then we'll just add on a premium on that. But behind that, was it like a short-term return? And what really has driven that return? Was it, a temporary gain on foreign exchange? Or was it a windfall from some sort of a big business deal? So all this leads into having a standardized, independently regulated, in our case by ECMA, a disclosure framework and regulatory framework. So in order to especially protect our relatively less informed or uninformed investors, be it institutional as well as individual investors, I think we need to have three disclosure frameworks at three levels. One is the awareness, which is with the issuers, why they need to disclose and on what aspects do they need to disclose, because there are probably 8 to 10 different categories which require disclosure, starting from the financial, operational risk and other different types of risk, governance and other legal, internal structure, and conflict of interest, material transaction, etc. We can go on and on. But all this, one way or another, will have a direct or indirect implication on the decision of the investor. So having the information out there and then creating that awareness and also providing the incentive is the first step. But it can't always be advising, encouraging, and incentivizing. So it has to be also mandatory. So the current different directives have clearly specified the level of disclosure and then also the frequency. So the enforcement is a second part, which is very critical, because if we just leave it open for the discretion of the issuer or the listed company, definitely there is always a self-interest and we'll prioritize that. So that means, as Teddy mentioned, I would like to keep the information which will have an adverse impact on the price and value of my securities and my company, and will only issue the positive ones. So in order to have a minimum standard of what information and how frequently would be critical. The third one is infrastructure and mechanism, because you can create awareness and then you can also make it mandatory, but at the end, if it's too costly and too inconvenient for a less aware issuer, then they would rather pay the penalty and then not disclose it. So we should not give enough excuse in terms of how it should be disclosed, and also it should not be too cumbersome, especially for different categories of issuers, because all companies, irrespective of the capital size, their geographic coverage, their risk exposure, the number of shareholders, etc., if we make it a uniform, a bit heavy and expensive to comply with, I think the level of disclosure will go down, and then we won't achieve the original intention or objective. So with these three things in place, I'm hopeful that we will have enough level of disclosure to meet the minimum requirement for Ethiopia. Thank you.
Thank you, Mike. Just a quick question I will give to David. We have heard about the three panelists on the Ethiopian context. I just want to give you 1 minute and describe us what our advisors, our architects should avoid as a mistake in this emerging market to move forward for the future.
Okay, so I'd say that we must start with building confidence and trust in the market before we start pushing complex products into the market. You'd want to avoid some of the situations we've seen in other places where there isn't too much trust, there isn't too much education, but some of the architects are pushing very complex transactions ahead of time. So it's important that the basics are put in place, let people trust the market. The early disclosures, the early enforcements must be done right. And let's keep it simple, plain vanilla, and let the market evolve over time. rather than looking for volume and complexity. So let's avoid that from the beginning and keep it simple.
Thank you, David. For the benefit of time, we will wrap up at this. And thank you for our esteemed panelists. Thank you for attending this interesting session. Thank you.